very much. Welcome to the inaugural lecture on the PIIRS-supported global systemic risk research community. What we're trying to do over the next 3 years is to explore a whole set of issues about globalization. Basically, our question is, yes, globalization brings all sorts of systemic efficiencies, economies of scale, etc. But does it come with an inherent cost? That is, the system very, very efficient, but extremely fragile. And one or two disruptions into the system lead to a catastrophic failure. And what does that mean, given that we are increasingly dependent on this continued flow of goods, whether they be energy, whether they be food, whether it be money. And we're going to be doing a series of events this year. This is our inaugural year. In December, we're going to be doing one on the implications of increasing AI and network connectivity. In the spring, we're going to be having a small conference on food security, global food security. We're also going to be having Jeffrey Parker, who has written a wonderful book about an equivalent crisis in the 18th century and how that spread throughout the world. And we're also going to have some visitors from Oxford and from LSE talking about risk and management. But today, we want to start with the most obvious example of these kinds of interactions, which is the global financial crisis, 2007-2008. The basic question is, how did a decline in prices in Las Vegas and San Bernardino lead to the biggest economic crisis since the Great Depression? Is it malfeasance? Is it stupidity? Or was there something architecturally inside the system that made it susceptible to this kind of failure? And for analysis of this, we've got Gary Gorton from Yale. Let me just give you a little bit about him. He is the Frederick Frank Class of 1954 Professor of Finance at the Yale School of Management, which he joined in August 2008. Prior to joining Yale, he was the Robert Morris Professor of Banking and Finance at the Wharton School, where he taught from 1983 to 2008. Professor Gorton has done research in many areas of finance and economics, including both theoretical and empirical work. He is the author of Misunderstanding Financial Crisis from OUP, and I think the best title on the global financial crisis, Slapped by the Invisible Hand, the Panic of 2007, also from OUP. He has consulted the U.S. Board of Governors of the Federal Reserve, the Bank of England, the Bank of Japan, the Central Bank of Turkey, and I'm sure the favorite part of his resume, he was a consultant to AIG Financial Products from 1996 to 2008. Gary, welcome.
Thank you. Thanks very much. I've been talking about the crisis now for a while. I sort of feel like my time is running out because Congress is busy trying to generate the next crisis. So then it's not clear whether this will be the worst crisis since the Great Depression or the worst crisis that was followed by the one they made. So it's not a pleasant topic, I can tell you. You know, the after effects of this are still being felt by millions of Americans. So it seems like it's something that we ought to, as a society, make a good faith effort to understand. And I'm gonna try to convince you that so far there hasn't been a good faith effort. And that's because I think most people can't actually answer this first question. If you ask them what actually happened, they can list a bunch of stuff they read in the newspaper, and they can say bankers did it somehow, but they can't actually explain, they can't give you a coherent narrative of what happened. And I should say that's not their fault really, because I'm going to show you that what happened wasn't visible to you. Unless you were on a trading floor, you wouldn't have seen what happened, and you wouldn't have been able to get the data that I'm going to show you. So the public and the politicians and the media didn't really have a chance to understand it, and they would have to have had experts explain it to them. And unfortunately, the experts didn't know anything either. That was the economics profession, the academic economics profession, which didn't stop them from talking to the press, but they were kind of lost. So to answer that question, we're going to talk about what is a crisis and what's a financial crisis. And I'm going to try to convince you that a financial crisis is not a loose term. It's not a bad event. It's not the last bad thing in the economy you can happen. A financial crisis is always a bank run. It's always a bank run. And it runs on all the banks. And it's not irrational. Depositors have a reason to believe that there's some problem. And they all ask for their cash back. And Franklin Delano Roosevelt, in his first radio address in the Great Depression, the one where he declares the banking holiday, he explained it very clearly. He said, you know, my fellow Americans, when you put your money in a bank, They don't just put it in a safe. They lend it out. And if everybody goes at the same time to get the money, they're not going to have it. And it's almost that simple, except you didn't see what the form of money was, and you didn't see what the form of bank was, because the financial system has transformed over the last 30 years. And as a result of that, national leaders never articulated a narrative like Roosevelt did. When Roosevelt gave his talk, the next day people lined up to put their money back in the bank. And nothing like that happened. So here's what you would have seen had we been talking about banking crises of the 19th century or early 20th century. You would have seen this. You would have been at the bank. We all would have been at the bank asking for our money. So it took 100 years to figure out what to do about that, but we knew what happened because we all participated in it. So I want to impose some criteria that I think you have to explain if you're going to explain the financial crisis. Otherwise, it's this diffuse, superficial stuff that won't get us anywhere. So I'm going to suggest that we have to answer three things. The first thing is, how did a small shock cause a large crisis? $1.9 trillion of AAA subprime that was outstanding as of March of this year had realized a 20 basis point loss. 100 basis point is 1%. 20 basis points is 0.2%. So all this subprime, AAA subprime that has been discussed has a 20 basis point loss. The losses on AAA prime bonds are higher. Okay? So this is a fact that a hardworking reporter could have figured out. You need the trustee reports from all these deals because the trustee is the one who actually calculates the realized loss. So we have this small shock, and it gets magnified into, of the 13 largest financial institutions in the United States, 12 were about to be bankrupt after Lehman Brothers. So a systemic event is the banking system. It's not the London whale of JP Morgan or anything like that. It's the whole system is bankrupt. Okay? So the first thing you have to explain is how a small shock can get to this. Now, of course, in order to do that, you have to have known there was a small shock. So we're going to think about that question. The next question we're going to talk about is you have to explain why the spreads on all assets rose. So when I say spread rise, that means price goes down. So every time you see a spread going up, it means price going down. So the prices of all bonds got crushed. And of course, you didn't see that because the bond market is an over-the-counter market. It's not traded in a centralized exchange. You never see it. There's nobody who's recording prices. So unless you're trading in the markets, you don't see these prices go down. Now, the important thing is that prices of bonds that had nothing to do with subprime or mortgages also got crushed. Right? So we have a lot of problems here, right? We have this little shock, we have this huge event, and it affects all these bonds that have nothing to do with subprime. So you have to piece these things together into a coherent explanation. Now, so let me show you what I mean by that. So here's a figure that has this red line. So all you need to know about this red line is that it represents what's happening in the subprime market. It's spread, so going up means prices are going down. So the prices will be going like that. So this says the subprime market is just deteriorating continuously. And it starts in the first quarter of 2007. And it was not unexpected. We all knew the subprime market was going to go down. We didn't know that the whole financial system was going to go down. The blue line is a measure of risk between banks. So it's a spread which measures interbank risk. So this goes up here in August 2007. And it stays flat, and then there's Lehman Brothers. Now the thing about this picture is that these things don't track each other very well, right? I mean, if you thought that it was all to do with subprime, you might think that this blue line would just track right along the red line, right? And it doesn't. And that tells you that the stories aren't as simple as what we've been told. In fact, look at this picture. This picture has the measure of interbank risk. And here's the spreads on three categories of asset-backed securities. I'll tell you what that is in a little while. These are AAA. Never had a loss in history, never had a loss during the crisis, never will have a loss. And yet they track this measure of interbank risk very, very closely. Okay? So it's a bit of a puzzle. You know, we've been told it's all to do with subprime. Well, this doesn't match that story. And what about all bonds? All bonds are getting crushed as interbank risk rises. So, you know, you would not, the government doesn't have these data, right? They don't have these data, and they don't trade, so they don't see these things. But nevertheless, that's the second thing we have to explain. So the first thing we have to explain is small shock, destruction of the whole financial system. And then the next thing we have to explain is why do we have this weird pattern in asset prices? Now the third thing is you have to take a view on whether the crisis is a unique event, a kind of special, unlucky convergence of many, should be a Y there, many bad factors. You know, so there was the subprime, and then there were these new instruments we never heard of, like credit derivatives, and then there was bonuses, and there were all these things, and they all came together, and somehow we don't understand how it caused a crisis. So that's a view that each crisis is some kind of special, unlucky event that's caused by people making bad decisions. Or it could be a structural issue that's related to deeper problems with short-term debt and trading and liquidity provision generally. So I'm going to show you that the kind of financial crisis we experienced is pretty common in market economies throughout history. There's periods in some economies, long period where you don't have a financial crisis like we did from 1934 to 2007. And the more interesting question is, why didn't we have a financial crisis during that period? So if you see financial crises over and over and over again, it just seems like this is a kind of not very likely explanation. So I'm going to try to convince you that it's this explanation. That, you know, when good things happen because of the invisible hand, we don't go give medals to people and cite them in the newspaper for making good decisions. Similarly, when bad things happen and we get slapped by the invisible hand, it's going to be the structure. Something in the structure is causing this problem. Okay, so since 1970, there have been 147 systemic events around the world. So remember, a systemic event is the banking system is insolvent. And in every one of these events, the government and society is going to find a way to save the banking system, except in one case where the banking system was unintentionally liquidated, and that was Indonesia during the Asian crisis. Every other instance, the banking system is bailed out, nationalized, a blanket guarantee is issued, there's a bailout in every single one, because no country wants to lose their banking system. So these events occur in all market economies. All market, they're not just from an earlier era, and they're not just in emerging markets. So before 2007, if you asked an academic economist, they would tell you, well, these are events that only happen in the past. They're not going to happen to us. And when they happen in emerging markets. Not true. That's just not true. Here's developed countries. Developed countries. So, and many of these are very famous. You know, the Scandinavian crises were a disaster in the early 90s. So the idea that this is some kind of unique event seems kind of bizarre. Here's a map where the darker the color, the more financial crises since 1970. And if there's white, then there was no financial crisis. So Canada is an example. Australia is an example. So we might want to look into their banking systems to try to understand those. Somalia is an example. They don't have banks. Seems to be the current policy that we're adopting seems to be to get rid of banks. And then we have the winner, the all-time winner in this, which is Argentina. And they have a systemic financial crisis every 10 years. It's just sort of the home of bad policy. They're the one country in human history that has gone backwards. Right? In the 20s and 30s, they looked almost like the United States. They produced as many cars as the United States, had as many stocks listed. Real per capita income was about 80% of the United States, the same as France and Germany. And now they're an emerging market because they've gone backwards. And one reason they've gone backwards is they can't solve this problem. So these are what these events all look like. Now, since 1970, of those 147, about 65, 66% of them involved a bank run. The rest the government intervened with some policy that prevented the bank run. So in the modern era, what happens is the bank run typically comes late because everybody's expecting the government to do something. And it's only when the government doesn't do something that there's the bank run. So behind a lot of policies is the counterfactual. There would have been a bank run. And it's a very tricky thing. You know, I asked Tim Geithner about this, you know, about the political constraints. Did he face political constraints in the crisis? And he said to me, he said, you know, you have to let the crisis get bad enough that everybody understands that it's a bad crisis. And they'll be willing to act. But you can't let it go too far, because if you go too far, then you can't save the banking system. So it's all a matter of timing, right? That's the sort of conundrum for modern policymakers, right? The economy expects them to do something, they don't do anything, there's the run, but then you can't get a national consensus about doing something, so you have to wait for it to get bad, 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 and then everybody goes, oh my God, we should do something, and by then you're sort of halfway through it. So let's start with some banking history, just to refresh ourselves that this is not some kind of strange event. So banking panics in the United States, I'm just going to talk about the United States now, have been the norm. Before deposit insurance was enacted, you know, all of U.S. history had banking panics, and I'll show you the ones in the national banking era in a minute. Deposit insurance was passed in 1934, and it was not passed because of intelligent design. Economists were opposed to it because they said there'd be moral hazard. Bankers were opposed to it. FDR was initially opposed to it. But after 100 years of banking panics, the American public just said, we don't care, we want deposit insurance. And then Franklin Roosevelt ran out to lead it. And that's how we got deposit insurance. So let's start with the free banking era. Then we'll come to the national banking era. So this was a period in which banks issued their own money. There was no federal government money. So I would arrive from New Haven with a $1 bill that was printed by the Bank of New Haven. And I would go to buy some coffee, and they'd say, wait a minute, let me look at this up. Oh, that's only worth 90 cents here. And I'd say, what are you talking about? Yesterday it was worth 95. And we have to haggle over this and have some kind of transaction. And that's because this thing didn't trade at par. Par means if it says $1, it's always accepted as $1. So when the government started issuing this, it was this huge step in human history. This was the National Banking Act. And it wasn't passed to get this. It was passed to finance the Civil War. And it wasn't clear that this was even constitutional. The Secretary of Treasury at the time, Salmon P. Chase, got this through Congress. A few years later, he's Chief Justice, and he rules it's constitutional, basically, right? So now we have it. So now I don't have a problem. I can trade at par. Right? So again, that was not by intelligent design. It was a byproduct of this legislation. So after this period, after this is passed, everybody expects there to be no more banking panics. But the national banking era is this period, 1863 to 1914, and there's no longer a problem with money, it's government money. The problem now is checks, demand deposits. The picture I showed you was people running to withdraw from their checking accounts and savings accounts. So for the next 60 years, the government's trying to figure out whether checks are money. They're trying to measure the extent to which it's used as a medium of exchange. Academics are writing articles with titles like, Are Checks Money? And they can't figure it out. It was the shadow banking system of its time. Right? They just didn't understand it. So so now the banking system has changed again, and there's a new form of money, and it's called sale and repurchase agreements, or repo. So I'll come back to that and tell you what that is in a few minutes. Okay, so what happens during a panic? Everybody runs, and in the national banking era, it would start in New York City or a large city. Everybody would demand their money, and then the banking system's insolvent. Not because their loans are bad. Right? It's not an insolvency problem, it's a problem that they don't have enough cash to hand out the door, right? So you can have all the capital requirements you want. If you have to hand out the cash from the banking system, there's not enough cash. So that's what makes it systemic. And during these periods, checks couldn't be used, right? So there was always, during the national banking era, there's this problem of I lay everybody off because I don't have a way to pay them, right? So, and this was described as a currency famine, and then the currency went to a premium. So here's the panics. So if it's in red, it's a panic. The Great Depression before the Great Depression was 1907, and the Great Depression before 1907 was 1893, and the Great Depression before 1893 was 1873. So this is the National Bureau of Economic Research dating. This is the peak and this is the trough. They've never revised this backwards, so we have better data now, and we would revise this, but officially they haven't. So this would be when you hit the peak, and then you go for the next 6 years, you're going down. That would be revised with new data. Here's the panic date. This says, this is the percentage change in the currency deposit ratio. So people ran to the bank, they withdrew from their checking account, which would cause D to go down and C to go up. But the banking system suspends convertibility. The banking system just says, look, we can't pay out this money, we're just not going to give you your money. And that was always illegal. In the free banking era, there's a famous case about this where the New York Supreme Court rules that it's not illegal if every bank is suspended. So it was never enforced. So this thing doesn't go up as much as it would go up. Now we don't have GDP data on this period. We didn't have GDP data during the Great Depression. So one measure of economic activity is pig iron production, which was used to make rails for railroads. So by that measure, this really was a horrible recession. That's a 51% decline in pig iron production or real economic activity. And you can see the others are really horrible. We don't have unemployment data. Now, so everybody runs, everybody asks for their money. The banks say, we're not giving you your money, just go home. And after the dust has settled, what are the losses? What are the losses to depositors? So this number says 2 cents realized loss in national banks. 2 cents. That's less than a penny. That's almost nothing. Which tells you that it's not like after the panic we went and looked at all these banks and they all had bad loans. That's not what happened. They didn't have bad loans. They couldn't sell the loans, so they couldn't hand out the cash. That was the problem. So it's not, these events don't, it's not the case that the banking system is insolvent. Now I've known Ben Bernanke for 30 years. Maybe you know him too, since he was at Princeton for a long time. And I asked him about, why they didn't help Lehman out. And he said, well, they didn't have good collateral. And I said, well, how do you know that? They don't know what the collateral's worth in the middle of a crisis. So maybe there were other reasons, but at least in the national banking era, the losses and the actual failures were really small, really small. The real effect on the economy was large, right? Because you didn't have any money. So the economic effect of the event was large, but the banking system ends up not being so bad. Okay, so here's what the banking system looks like in the eyes of the government. In the eyes of the government, and in every textbook you're going to look at, this is what the banking system looks like. So in this regulated system, you have a bank which borrows from a depositor, pays them, say, 3%, takes the money, lends it out, say, to somebody who's borrowing for a mortgage, and they pay 6%, and the bank earns 6 and pays 3 and makes this difference, 6 minus 3. That's banking. And this ends up being insured, and this guy ends up being regulated and examined and has restrictions on what they can do and all sorts of things. Okay? That's not the banking system we have now. This is the banking system, in 1930 or even 1960. But starting in the end of the 80s, this is all going to change. So let's talk about bank debt. So the output of a bank is debt. It's debt. But the output of GM is cars. The output from McKinsey is consulting advice. The outcome from a steel company is cold rolls of steel. And the output of a bank is debt. So banks make a kind of money, right? A checking account, a free banknote, a savings account is a kind of money. And this money, if it's going to trade at par, right? If it's going to trade, always for $1, it has to be the case that when I offer it to Thayer, he just says, oh, fine, that's fine. He says, I don't want to investigate whether your bank is really solvent or not. He just accepts it. That's how money has to work. So even before we had paper money, there was a problem, right? If I offer him a gold coin, he's going to be worried that I clipped a little bit off it, and he's going to weigh it, and then I'm not going to believe his scales. I'm going to say his scales are wrong, and he's going to say my gold dollar isn't $1, and when I can't buy lunch. So we have to have something that's designed to prevent losses to insiders. So I don't know what my bank is. I don't know what Bank of New Haven is worth. Thayer's telling me this is only worth 95 cents. I don't know. But if I want lunch, I have to accept that. So you want to design something where he just takes it, no questions asked, like we can with government money. So to do that, we have to design the debt to be information insensitive, which means Thayer's never going to decide that he wants to do due diligence on this money, go investigate my bank. There's no reason for him to do that. That's what it means for this to be information insensitive. So then $10 is always $10, but this can shift. What's going to happen is an event is going to occur and we're going to get this, things are going to fall over a cliff. It's a discontinuity and it'll become information sensitive. Right? So now I offer to Thayer, he says, no way, I don't want that, it's worthless. Yesterday he was willing to take it for $1. So some event happened that changes the information environment. So this would be this case, the example at the bottom. Now, so all bank debt is backed by something. It's backed by something, right? The assets, the collateral. Free banking era in the states that adopted it, their private money issuance was required to be backed by state bonds. So I have to go to the state capital of New Jersey, deposit my bonds. New Jersey would print my notes, and I'd take them back to the bank and lend them out. And the problem was that state bonds, before the Civil War, were not riskless. We defaulted kind of, in the 1840s. When we got to checking accounts, the backing is diversified loan portfolios. But it's not just any loan portfolios. Banks choose loans that make it hard for you to investigate them. They lend to consumers, small businesses. You couldn't possibly figure out what their portfolio is worth. It would cost too much for us to investigate every mortgage and every small business. So you can't figure it out. So demand deposits are kind of a complicated security, right? Because it's two-name paper. It's got the bank name and then you sign it for your account. So it can't trade in a market because you don't write enough checks. So then all that's going to go inside the clearinghouse. And the clearinghouse is a private organization where banks are going to monitor each other and check on each other. This is how bank examinations started. So in the money that we're going to be interested in, primarily repo, what happens is a depositor deposits $100 and goes away with a bond, takes a bond away as collateral. So that's the backing. That's the backing for it. And these are other forms of things that are similar that I'm not really going to talk about. So let's talk about debt. So I just want to give you a better sense of what this information sensitive, insensitive means. So this is a picture of a debt contract. The face value is the maximum amount you're going to get. So if you have a US Treasury bill, it doesn't have, Treasury bills don't pay interest. They're issued at $90 and at maturity you get $100. So this would be $100, right? And on the bottom here is what the backing is, the final value of the backing. If you get near this point, they're not going to be able to pay you the $100. And if it's a private company, you get to recover everything they have, at least in the UK you do. In the US you go into bankruptcy and fight and lots of things happen. But in principle, this is the bankruptcy point. They can't pay you $100, they can only pay you $50, so you get all the collateral, all the backing. Okay? So this is a deceptively simple contract. Deceptively simple contract. It looks like it's a no-brainer, but it has a really cool property. So what I'm going to do is I'm going to show you the distribution of these final collateral values. So here it is. So I've made it a normal distribution because I thought that's what you'd be used to. In reality, it wouldn't be normal. But with this distribution, so up here I have the likelihood of these different collateral values, and down here it's the same as before in the previous picture. So this says that this is the mean. We expect on average to get for the collateral to be worth this. Right? But it has some risk by this standard deviation. So private companies can't make purely riskless collateral. Apparently the government can't either. So now I'm going to put these two pictures together. Here's our bank, our debt contract. And here's the distribution of collateral values. So here it's all collateral values for both lines, but over here I have two axes. One measures the likelihood, and one measures the face value. For example, Suppose this is $300. We expect the collateral to be worth $300, and that's going to happen with, a 30% chance. That would say, I'm pretty safe because I get my collateral for anything that is realized on the flat part. Where I don't get my collateral is when we're over here. Then I get less than 100, right? Because this is well, I made it $10 here, but so if it's $10, anything over here I get less than $10. So what's the likelihood of me getting less than $10? What's my expected loss? It's that blue triangle. It's that blue triangle. So if I think about producing information about this, I'm going to spend a lot of time and resources analyzing a particular bank, and it's just not going to be worth it because even if I found that out, the likelihood of that happening is so low that I just wasted all my time and money. That's why you don't ever hear about bond analysts. There's only equity analysts. And equity is a line that would go like this. From here, no, it would start here and go straight up. Like that. Here's where equity starts to have value. It goes like that. So equity is sensitive always to what the collateral backing value is. Always. So institutionally, it trades on a centralized exchange. Everybody spends a lot of resources figuring out what it's worth. But debt trades over the counter, and nobody spends a lot of time figuring out what it's worth unless it's junk bonds. So this says that this deceptively simple contract has this beautiful feature that it's kind of not completely immune to learning about information, but pretty close, pretty close. Now, so what does a loss of confidence mean? Here's what a loss of confidence means. Suppose we find out the macroeconomy is going into recession, so the distribution shifts to the left. That's what bad news would mean for the macroeconomy. Distribution shifts to the left. Now the relevant portion is this red portion. And if that's big enough, then you start to worry. Somebody knows, it pays somebody to learn what the realization is. Is it in here? And you don't know if they've produced the information. Maybe you've produced the information. And suddenly the money has a problem. Suddenly the money has a problem. So debt is relatively information insensitive. When the macroeconomy changes for the worse, it could become sensitive. That's this leftward shift of the distribution. And if it is big enough, then you get this cliff effect. We had all this stuff that was information insensitive, and boom, it's now sensitive. Okay. That's why there's a demand in the world for safe assets, safe debt. 40% of the debt in the US, treasuries, agencies, corporate bonds, asset-backed securities, are sold and held abroad, right? Why does China and the oil-producing companies want to buy treasuries? Because they're information insensitive. It's a store of value. It's never going to go down in value unless Congress does this lunatic thing, right? So they want something that is a safe store of value without having to worry. Why doesn't China buy equities? They don't know anything about U.S. equities and U.S. companies, and it's too risky to do that. So debt has all these nice effects that it's information insensitive. Now, let me show you a picture of what this looks like for the U.S. economy. So this is a picture of safe debt. This is safe debt produced in the United States from 1952 through 2012, 11 maybe. This part is U.S. Treasuries, bills and bonds that are not held by the government itself. So they're not held by Social Security or the Fed or anything like that. Up here is everything that's produced by the private sector, which is checking accounts, savings accounts, money market mutual funds, asset-backed securities, repo, commercial paper, all those instruments. Now, this is expressed as a percentage of total assets in the United States. So total assets in the United States have gone up exponentially. The wealth in the world has gone up exponentially in the last 50 years. But this says that as a percent of total assets, the fraction of safe assets has always been on average 32%. Right, so you can check this econometrically, it's always 32%. So there's another thing to notice about this. This is the aftermath of World War II. So when the government didn't have to finance armies anymore, they stopped issuing as much debt. And what happens? The private sector fills in. Right? The private sector starts to issue privately produced safe debt because there's a demand for it and the government's not producing enough of it. So before the crisis, this was a huge problem. There wasn't enough stuff that was good to use as collateral. And it's a big concern going forward that there's not going to be enough stuff used for collateral. In fact, if the government creates enough uncertainty or does default on the debt, the problem is all this is not safe anymore. Right? It's a huge problem. Never mind the fact that I don't know what they're going to do. They don't have $35 billion they can't pay out. That's the problem for somebody, if you're on Social Security or something. So the next I want to look at the composition of this stuff. So here's the types of safe debt produced in the United States. So this is checking accounts and savings accounts. You can see that it's just become less important. Right? It went from 80% to around 30%. And what are the two big areas that have filled in? This is money market instruments, sale and repurchase agreements, commercial paper, and this is asset-backed securities, and this is other. This, from here to here, is bigger than from here to here. Right? Let me say it again. This, from here to here, is bigger than from here to here, which tells you that the shadow banking system, this, is bigger than the regulated banking system. Right? So we're going to investigate what this is. But this tells you that the economy has changed very dramatically. We don't rely on this stuff as much. We rely more on this. And why don't we rely on this? Well, because you put your money in a lot of other places. You put your money into money market mutual funds, which is in here. Most of your savings is managed by professional managers, institutional investors, which are massive. They weren't so big, 40 years ago, 30 years ago. BlackRock manages almost $4 trillion. And they're just massive. So the world has changed. So let's talk about the instrument we're interested in. We're interested in repo. So repo is a sale and repurchase agreement. It's a deposit of cash, which is short term, usually overnight. It receives interest and it's backed by collateral, and the depositor takes physical possession. So let me just put names to this so you can have a mental picture. Take Fidelity, a big mutual fund company. People send money in to go into certain accounts. They're going to buy certain securities. They don't know when or what. So they have a lot of cash. What do they do with this cash? Well, they want to earn interest on it. The problem with cash, it doesn't earn interest. So they want to take it to a bank, but they want it to be safe. Well, there's no insured accounts for if you have $500 million to deposit. So they're going to go to a dealer bank, let's say Bear Stearns. They say to Bear Stearns, I want to lend you $500 million. Bear Stearns says, okay, we'll pay you, 3% annualized overnight. You're just going to hold it overnight. And to make sure it's safe, Bear Stearns is going to give Fidelity bonds with a market value of $500 million. And at Bear Stearns Clearing Bank, those bonds are going to move from Fidelity to Bear Stearns. Okay? So let me put numbers on here. Fidelity deposits the $500 million. Bear Stearns is going to pay them 3%, gives them the bond as collateral. Bond earns a return of 6%. That goes to Bear Stearns, right? So Bear Stearns is getting 6%, paying 3%, just like other banks. And not only that, the bond is going to be linked to portfolios of bank loans. So we're financing bank loans, just like the other banking system did. And we're doing it the same way. There's depositors, you pay them 3%, you earn 6%. It's a spread business. The difference is going to be the depositors are different. Okay, so repo is short term. It's very short term. It's like playing speed chess, right? So every morning, the repo traders come in at about 7:30. Around 8 o'clock, they start to make calls to counterparties, and they say, do you want to roll? Because the next morning, you might need your cash if you're Fidelity. So you have an opportunity then to withdraw cash or put more in or do something. So $10 trillion is rolled every morning, right? Big number. And you can see why this information insensitivity thing is crucial, right? Because if I'm Fidelity and I say, well, what bonds are you going to give me? And they say AAA credit cards, and I say, well, I have to go analyze that. You know, you can't deposit overnight if you have to stop and do credit risk analysis on these bonds. The bonds have to be bonds that are accepted, no questions asked. Otherwise, this system doesn't work. So we have to produce bonds. If it's treasuries, then there's no questions asked till now. But we don't have enough treasuries because they're all in China, then we have to produce something. So this is also carved out of the bankruptcy code. It's another reason it works as money. So Fidelity puts $500 million in. If Bear Stearns files for bankruptcy, Fidelity just unilaterally terminates the agreement and owns the bonds. They can sell the bonds. So if the company on either side goes into insolvency, you just unilaterally terminate. You don't end up in a long, dragged-out bankruptcy procedure. The collateral may be rehypothecated, which means that when Fidelity gets the collateral from Bear, they can use it for something else. They can ship it off to Deutsche Bank to collateralize a derivatives position. And Deutsche Bank can borrow against it with SocGen. And, you know, so this bond is like flying around the world. And then when Fidelity has to give it back, they have to go buy it. So rehypothecation is like a velocity to the collateral. And it creates more collateral to the extent that you have systems set up to move these bonds around. We have no idea, I mean the government has no idea of the extent of rehypothecation. And economists didn't know what rehypothecation was, and they still can't spell it. So, you know, it's like this giant black hole in the economy that we didn't know about. Now, what we're going to be interested in is this last item. And the last item says that Bear Stearns, Fidelity might want to have bonds that are worth more than the amount they deposit. They want to be over-collateralized. So suppose, for these numbers, suppose Fidelity deposits $100 and Bear goes and buys a $100 bond and gives it to them as collateral. Right? So the entire bond is financed by Fidelity's deposit. The next morning, Fidelity says, yeah, I'm willing to deposit again, but I'm a little worried about you and the bond and the state of the economy. So you know what? Give me $2 back, but I want to keep the bond that's worth $100. Now, so what they've done is they've withdrawn $2, right? The bond was financed completely by the repo deposit. Now the depositor wants the $100 thing to be financed, but they're only willing to finance $98 of it. $2 has to come from Bear Stearns. They have to sell debt somewhere else, sell equity, get a loan, sell an asset, do something, right? So you just have to see that's a withdrawal from this banking system. If haircuts go up, it's clearly a withdrawal if haircuts go to 100%, right? If Fidelity just says, I'm not giving you anything, then Bear Stearns has to finance the $100 bond themselves or sell it, right? Okay, so who's in this market? Well, the depositors are institutional investors, the rest of the world, and some pension funds, state and municipal governments, and so on. And to be a bank that's a depository institution for all these clients, you have to have collateral. And since the collateral pays you 6% and you're only paying them 3%, just like other banks, it's going to be a deposit business, and you're going to have to go get the collateral. Here's who's in this business. This is the depositor side. So a lot of it's the interbank market. Rest of world, we don't know who these people are, rest of world. And then there's institutional investors. This is in the bilateral market, right? When you read in the newspapers about the New York Fed is working in the tri-party system, that's about 20% of this. Most of this is Fidelity dealing directly with Bear. Okay, here's part of what's happened. This is just from 1995 to 2005 is the growth in assets under management from institutional investors. So if you go back to say 1965, this is almost nothing, right? And it's grown in the last 30 years. So these are huge growth rates. These are massive pools of money, right? This is the Kuwaiti Investment Authority. If you know, in Singapore, there's Temasek and GIC. In China, there's a State Authority for Financial Exchange. These huge, huge pools of money. Then there's the other banking system. This is money market mutual funds. This is another innovation. So this was a complete regulatory arbitrage, right? Banks couldn't pay interest, money market funds could, they didn't have to hold capital, so they just took market share away from banks. Now, so here's a snapshot of the repo market. So this is data from their annual reports. They're not required to provide this data, but they mysteriously all did starting in 2000. The numbers are all the same since then. So the number you want to focus on is this. This is the fraction of total assets owned that's financed by stuff that's pledged, repo. So it's all about 50%. Now, if you looked at an uninsured bank before 1934, a depository institution, the Bank of New Haven, their assets would be about 70% depository finance. The way banks make money is they issue this debt. So these guys were really conservative. I would describe this as really conservative, right? I mean, they're not, you know, this is not crazy. It's not insured, but it's not crazy. And remember, it's a business. It's a depository business. Okay. All right, so we don't know how big the repo market is. You know, the New York Fed has data on the banks that are allowed to trade with the Fed, but they don't have it on everything else. So I estimated this to be $12 trillion, and I publicly stated this number, and I was laughed at and sneered at. And then the BIS, Bank for International Settlements, some of their economists came out with basically the same number, and then the IMF and a third method came out with basically the same number. But these are all back of the envelope calculations. The fact of the matter is we just don't know how big it is. Okay. All right, so what's the collateral? What can we use as collateral if we run out of treasuries? So here's the outstanding debt in the US capital markets. This is treasuries. This is corporate debt. This is mortgage related. So this is mortgage-backed securities, commercial mortgage-backed securities. This is agency bonds. So if Freddie or Fannie, the big mortgage outfits, if they just issue a bond, it's down here. And this is non-mortgage asset-backed securities. So these are mostly credit card, student loans, and auto loans. Okay? So if you just look at this, 43% of the available collateral is going to be one form or another of an asset-backed security. And since a lot of this is held abroad, we're going to have to start relying on the privately produced stuff. Right? So here's the amounts held abroad. It's big. Here's an estimate of where we need collateral. We need collateral, so take out the foreigners, you got about 16 trillion. Derivative contracts have to post collateral if it becomes a liability for you. There's a survey, it's about 4 trillion. Here it's about 12 trillion. And then there's another big black hole. How much collateral is needed in the plumbing system, the clearing and settlement system? Again, we have no idea, none at all. So you begin to get a picture of the shortage of collateral, and in particular the shortage of treasuries as collateral. So the private sector made this through securitization. So here's how securitization works. You have a firm over here. It could be a bank, but it might be Sears, has credit cards, for example. This bank has made loans, and they're going to sell these loans to this guy, who's a special purpose vehicle. And this guy is going to buy the loans by issuing securities in the capital markets. AAAs, AAs, A's, triple B's, and it keeps the equity piece. So these bonds are linked to the portfolio that the master trust bought from this firm. So this could be, you know, like 30,000 auto loans, all, you know, originated by Ford. And then these bonds would be linked by seniority to those auto loans. So if people don't pay their auto loans, and a lot of people default, this guy, the most junior piece might suffer a loss. But in any of these securitizations, this piece is about 85% of how these things work. Okay? I think of these things as pretty simple, but I realized during the crisis that they're complicated if you don't work in them. Subprime is certainly complicated, but we want them to be complicated because we don't want people looking in the box and trying to find that blue triangle, because we want to use it as collateral. Now this thing is a set of rules. There's no physical location, nobody works here, it's just a bunch of rules. And it's set up so that it can't go bankrupt. So if you don't have enough money, you say to this guy, I don't have the money, so I'm going to start amortizing you out. I'm going to start paying off principal. So you never default on a coupon payment, you early amortize. That's what can happen. So securitization led us to this banking system. This is the banking system that was regulated and was on the radar screen of the regulators. So these banks, or Sears, are making loans. Here are mortgages. The mortgages are going to be packaged by the wholesale bank, the dealer bank, who's going to sell them to institutional investors and keep some of it because these guys also want to deposit through repo here. And then they can take their bonds or the collateral and rehypothecate it. So when the crisis happened, this is what the government knew about, right? The rest of this, they didn't know about, they didn't know how big it was, they didn't have any data. They had to learn during the crisis. So the point is this is a real banking system, right? This is a real banking system. Institutional investors need checking accounts just like you and I need them. And we've transformed how you finance bank loans through securitization. So it's a genuine banking system. And if it doesn't work, your economy doesn't grow, right? You can hate bankers all you want. If this doesn't work, your economy doesn't grow. So if you don't do something positive about this, you just have to wait for it to come out of a coma itself, right? So what does this have to do with the crisis? Well, these are subprime originations. So in 2005, 2006, about 1.2 trillion was originated, and what happened to it? Where did it go? Well, it was securitized, right? It was securitized. So we don't know where it went. So I want you to think about this with the following story. How many people here have been to a slaughterhouse? Okay, you a vegetarian? No, okay. Yeah, I grew up in Arizona out in the desert, and our neighbors were this big Mexican family that had the Tovria slaughterhouse and stockyards. And so I knew their kids, and I went to see the slaughterhouse, and what happens is the cattle get lined up in a chute. They do now because of temporal grandeur. But, and then a bolt's fired into their head. They're lifted up by their feet. They go into this refrigerated room. The butchers with all these bloody aprons they carve them up. And if we're making hamburger, they grind up the beef. So a lot, not many, but a lot. It's about 30 head of cattle go in. And you grind up the beef to make hamburgers, and you mix it. The beef from one one steer is mixed with another steer, because Americans want to have burgers that have the exact same fat content. Otherwise, they think it doesn't taste good. So you have to mix it. Now later, if somebody has a hamburger and they get E. coli, the government knows, if you have the package, it has a barcode on, they know exactly which slaughterhouse and exactly which lot this came from. You know what they do? They recall 1 million pounds before that lot, 1 million pounds after that lot, because they're worried that you didn't clean your grinders between lots the way you're supposed to. And everybody, all of us say to ourselves, my God, the FDA is incompetent. So we stopped buying beef because of one case of E. coli. Right? You get the E. coli, you're dead, right? In the 19th century, if it happens to be your bank that defaults, you lose your life savings. So of course you want your money. So the problem is you have this small event, but if it changes beliefs suddenly, then you're going to have a big effect. So this is what causes the panic. Haircuts for major dealer banks were 0 on all asset classes before August 2007. A change, as we discussed, a change to a positive haircut is a withdrawal from the banking system. We went through this example. Here's a picture of the withdrawal. So this is a equally weighted average of structured product haircuts. Okay, so they're all zero. This is from a high quality dealer bank. I had to give this data to the government. You can see that here's Lehman. So here's a back of the envelope calculation so you understand what's going on. Let's imagine the repo market is 10 trillion. And let's say that the average haircut goes up to 30%. So that's a withdrawal of $3 trillion. Now, you don't have $3 trillion. You're going to have to get it somewhere. And we'll talk about that in a minute. But where does that $3 trillion end up? The Fed buys $2 trillion, and the commercial banks buy $1 trillion. The problem is the process here of getting the money to pay people is pretty painful. Remember this picture? I said we had to explain why the prices of these things, AAA student loans, AAA credit cards, and AAA auto loans, moved with the measure of interbank risk. So here's what's happening. Fidelity says, we don't want to deposit with you anymore. And Burr says, oh my God, I can't finance this $500 billion of bonds. Everybody's withdrawing. So what does Burr do? Burr says we have to sell assets. We have to sell assets. What assets do they sell? Not their subprime. That's not going to raise any money, right? $100 subprime bond's probably worth 40. After the crisis, it'll be worth 95, but then it was worth 40. What they sell to raise their most money is the best stuff. The best privately produced collateral, which is this stuff, which has nothing to do with mortgages. That's what they sell. Everybody sells it. The price gets crushed. And they do this when their perceived risk goes up because of the withdrawals. So this is these fire sales that were forced by the withdrawal. And by the way, these guys, what they should have done was suspend convertibility. You know, when I was at AIG Financial Products, you know, we had all these collateral calls. What we should have said is, we're not giving you a penny. Too bad for you. And then Goldman would have had to suspend, and everybody would have had to suspend, and we wouldn't have to sell assets, right? And the big effect wouldn't have occurred, just like in the 19th century, right? The problem is that was a dim memory, right? Nobody remembers that we used to suspend convertibility. So here's the net decline. So this is netting out interbank market. Here's the net decline in the repo market. And who did it? The two big parties are rest of world and statistical discrepancy. This is from Fed funds data, Federal Reserve data. So statistical discrepancy means we don't know, we have no idea who they are. But whoever they are, they withdrew a lot of money. Part of the black hole. Now, so just a few more things and then I'll stop. I just want to explain again how you can get these anomalies in these markets when these banks are forced to sell assets and they choose to sell their best stuff. So I'm going to show you a picture of AA minus AAA yields on 5-year industrial bonds that uses on-the-run data, which means these were recently issued. At each point, they were recently issued. So there's no stale ratings and no stale prices. Okay? So AA is a little bit riskier than AAA. So if the AA spread is, say, 6%, the AAA spread should be 5%, say. So that spread for, since 1922 has been positive. AA minus AAA spread has been positive. Here it is in the crisis. It goes negative. Why is that? Again, it's because if you want to raise money, you sell your AAAs. You think that'll get you more money than if you sell the AAs. And everybody reasons the same way, and you crush the price. Right? So these forced sales, right? Remember that, in the 19th century, you would suspend convertibility, and the clearinghouse would take over. In 1934, everything was messed up because the Fed messed it up. We can talk about that later. But here, there's no discount window for these guys. The discount window doesn't work anyway because of stigma, and there's nothing you can do. And you've forgotten your financial history, so you don't suspend convertibility, so everybody has to sell all these assets. And that's what causes these firms to get into trouble, right? That's what causes them to have problems. And then the outside world says, we didn't see anything behind the curtain. all we see is these big firms in trouble, and we have to have a narrative about that. So the narrative that's been cooked up is bankers are bad, evil, greedy people. They concocted these toxic assets, which they sold to stupid investors with inflated ratings. That's their crisis theory, right? That's your claim. It's a very special event that's due to this kind of human greed. When you think about all the crises in history of capital markets or market economies, all involve short-term bank debt. Only difference here was a different form of short-term bank debt and a different banking system. But if you didn't see that, then you wouldn't have understood this. So, I used to yell at Bernanke about this. I said, you got to stand up and give a narrative. You got to give a narrative. And when he finally did at the Jackson Hole Conference in 2009, it was too late and it was too academic. He's citing academic papers. It wasn't like FDR. You should go on YouTube and listen to FDR's speech. It's one of the most it's fantastic. And it manages expectations of people in a very credible way. And we didn't see anything like that in this crisis. So there's the paradox of financial crises, and then I'm done. The problem is that throughout history, societies have prevented their banking systems from being liquidated. So you save the banks, but that saves the bankers. And the public view is, well, those are the evil, bad people who caused this, and you saved them. So you get this massive blowback, and then when you're trying to pass reform legislation, it's informed by that. So the two big pieces of legislation in U.S. financial history, the National Banking Act, which created money, not passed to create money, passed to finance a civil war. Deposit insurance, not passed because anybody wanted it other than the American people. Dodd-Frank is the same thing. It's like every other crisis. There's a few good things in there, but it doesn't solve the problem. So we have a sort of a bigger problem, which is that in the heat of the moment, when you can get something through Congress, we don't have far enough, we can't wait far enough for everybody to kind of settle down and talk about this sensibly. We have to do it right away, and then we don't get reform. So that's why I said at the beginning that I could have titled this talk, the next financial crisis. So unfortunately, you have that to look forward to. Thank you for your attention.
Yeah. The first chart that I think you showed about the financial crisis, Australia and Canada were different.
Yeah.
Australia, I think if I recall correctly, only had 2 events. And what is it?
Before 1970, yeah.
What is it that they do?
That's a great question. So let me tell you. These countries have a few very large banks. And you know why it works? Because they're in an informal club with the central bank. And it's like a monopoly. They get some monopoly profits from that, and they don't want to disturb that relationship, so they behave. That's a system that works. Or you can have one giant bank like the Bank of England, but that didn't work. Yeah.
You showed a plot where there was this statistical discrepancy, right? Like you couldn't track people. I mean, you couldn't track money, or who took out the money and stuff like that. Why is that? Given
so it's part of the problem is that the world is so integrated that we have a hard time keeping track of the foreign part. But also, if the data is not systematically collected somewhere, the government has no way of dealing with it. For example, hedge fund data, not reported, right? So they're lumped in with households in the Fed funds data. So you have these measurement issues. I mean, there's a bigger measurement issue, which is that we measure things based on cash, right? So we measure your assets, we measure your liabilities for accounting reasons. We measure value added for GDP, that's based on cash. But in a world of derivatives, there is no cash. There's just contracts moving stuff around. The measurement systems we have are so antiquated that you're never going to detect where the risk is because you don't have the right measurement systems. So Dodd-Frank, one of the pieces of Dodd-Frank, which I thought was great, was they set up the Office for Financial Research, which is in Treasury. And it's very powerful. It has subpoena power. It has the power to tax financial institutions to make up its budget. And the testimony of the head of Office of Financial Research can't be vetted by anyone. So in principle, this outfit could tax all the banks, hire 2,000 economists, buy 10 Cray computers, do some research, go to Congress and say the Fed has no idea what we're doing, here's our research. Right? They could do that. What they should do is work very hard on a new measurement system, which I proposed together with Marcus Brunermeyer of Princeton and Arvind Krishnamurthy of Northwestern. And it addresses this problem of where is the prop trading going, where is the risk going, does it move over the business cycle? We need sort of national risk accounts, right? And you know, the momentum for that has been lost. In the Great Depression, Roosevelt sent people out to count boxcars to see if the economy is going up or down. He didn't know. We didn't have like GDP growth was only 1% this quarter. He didn't have any of that. So, and there were no unemployment numbers. So he was very interested in getting GNP accounting going. And Simon Kuznets, who got the Nobel Prize for it, moved from Columbia to the Bureau of Labor Statistics. And before they could lose interest in GDP accounting, World War II broke out. And the government said, well, if we turn all the car companies into making tanks, how much will consumer spending go down? And so they were these urgencies to get GDP accounting, right? The urgency to do anything about a new measurement system is gone. It's gone. And you can't do it yourself, right? We can't do it. We have to have the government behind us, like they did with GDP accounting. That'll take about 3 or 4 more crises to get there. Yeah.
I was interested in your comment about asking Ben Bernanke why he didn't bail Lehman Brothers out, and he said there wasn't enough collateral.
Yeah.
A few years ago, we asked the same question of Henry Paulson.
Yeah.
And he said, I'm glad you asked. We couldn't do it. We tried to get other investment banks to back Lehman up. They refused. And the government couldn't do it because we didn't have the enabling legislation yet. Do you buy that?
So I've asked them about this also. You know, let's just go back to the 19th century for a minute. In the 19th century, you had these private bank clearinghouses. They did bailouts of members. They would not let a member fail during a crisis. And they would publicize, we're bailing this guy out. And they also did things like stress tests. If there's rumors about that bank, they'd send a team in, and they just announced, the clearinghouse says they're solvent. The rule was, you never let a big bank go in a crisis, right? Now, for 50 years, economists have been saying moral hazard, too big to fail, too big to fail. So in August 2008 at Jackson Hole, a lot of very senior people who now won't admit that they said this, said, we have to let one big one go to punish him, right? Could they have bailed Lehman out? Yes, they could have. Under 13.3, they can do whatever they want. That's a section of the Federal Reserve Act that says under unusual and exigent circumstances, do whatever you want. You know, it's a disaster. But if I was Ben Bernanke, I wouldn't have bailed Lehman out either. You know why? Because if they had bailed Lehman out, the political blowback would have annihilated the Fed. So you had this choice. If you want to lose Fed independence and have Congress run it, you bail out Lehman. Now, Ben will never admit that. You know, he's going on the collateral thing. But, you know, it doesn't make any sense to me. I mean, he can't stand up and say what I just said. And he says, you know, to my deathbed, that's my story. And I'm thinking, okay, we'll wait to see your book. Yeah.
It sounded like one thing you thought was going wrong was a timescale problem. Even though the underlying assets were there, couldn't be supplied fast enough when the haircuts were taking some stuff out of the system. So you said capital reserves wouldn't help because they wouldn't be available fast enough to deal with this kind of thing. What's the corresponding constraint, the thing that corresponds to increased capital reserves that could have been imposed that would have supplied the fast assets to keep people from selling off their high-quality stuff in fire sales?
So, very good question. So let me just start from the beginning. So in the beginning, you made a good point. In any economy, the real assets have a longer time horizon than money. right? We're going to go buy money, then we're going to buy groceries, and meanwhile, a submarine takes 2 years to make, right? So you always, inherent in any economy is this kind of mismatch. And so let's take capital requirements. If you increase capital requirements, it just means they hold a different kind of security other than debt. So they're less profitable. Banks are then less profitable. Can't issue as much debt. That's where they make their 6-3 part. These people are private citizens. They don't have to be in banking. They can exit. So if you put punitive requirements on a bank, they're going to exit. All the regulators do is determine the size of the regulated banking system. So the counterpart is you have to have dollars. The problem is everybody comes, they all want their dollars, right? So you can't hold, unless you hold everything that was posited as dollars, there's no solution, right? The demand for debt is very large and you can't hold dollars against all of it. So the solution here is, and I proposed this in a paper with one of my colleagues called Regulating the Shadow Banking System. The solution is get the government involved in overseeing the securitization process. So you have to create confidence, like the FDA, that there's no E. coli in there. And only the government can do that. That's got to be the government. They're the only ones so far who can create safe assets. But that's limited. Like, look at Greece. They can't create safe assets. So the government's got to get involved. Now, if they don't get involved, then you have this wounded banking system. It'll take a long time to recover. And we will end up, with a lost decade. We're already halfway there, so. Yeah.
So I noticed that the haircut graph is on the structures product.
Yeah.
And I was wondering
I have it for other stuff too, by the way. Okay. I have it for corporate bonds, but the haircuts only go up a little bit at the end.
So just based on the, all the data that you have on haircuts for the different asset classes, what's like the applied magnitude of the run?
Well, the picture I showed you, the only thing I can do is that back of the envelope calculation I did. That's all I can do. So that was 30% haircut on average. Let's take that. 10 trillion repo market. 3 trillion was withdrawn. Where did it go? The Fed bought 2 trillion of it, and the commercial banking system bought 1 trillion of it. And the process destroyed the banking system, basically.
So the 30% would be like a rough back of the
Yeah.
of like average haircut.
Yeah. So haircuts depend on the two counterparties and the bond that's used as collateral, right? So there's market-wide haircuts for categories of PIIRS, right? I showed you haircut data from 2 high-quality dealers. So they were 0, but that's not. I have data on a dealer bank meeting hedge funds. So for the same collateral, it's like a 30% haircut. So with hedge funds, the hedge funds want to borrow money. So they're giving the bond to the bank, right? And the bank will say, oh, it's a 30% haircut, and then turn around and borrow against it at a 0 haircut. Pretty good business. That's called prime brokerage.
We have time for a couple of questions, and I am going to impose my dictatorial authority. Jake?
My question was raised. So.
Okay. Jake, you had a question?
Yeah, so I guess I never understood the answer to why the puzzle you set for us, which is the lack of financial crises in the U.S. from 1934 to 2007.
I mean, why was it safe?
Yeah, what was different?
No, that's a really good question. So, I'm going to get to your question. I'm going to tell you another story. So imagine a graph. I'm going to show you a graph in your mind of debt divided by GDP for Thailand and for India. So Thailand goes like this. It goes up, Asian crisis, then it goes up. India, it goes kind of like that. Now let's look at real per capita GDP. For Thailand, it goes up, goes down a little, and goes up. It's everywhere above India, right? So, and the reason I mention that is that you can repress the banking system and get some stability, or you can risk a crisis every 20 or 30 years, which is very costly, but you get innovation. So what we did was by dumb luck, what happened with 34 was not only deposit insurance, but it was limited entry, right? It was very hard to get into banking. And remember, we didn't have banks across state lines for decades. So if you were a bank in Princeton, you were maybe one of 2 banks. You couldn't pay interest on your demand deposits by law. Money market mutual funds weren't invented. You had a local monopoly. So you had insurance, a local monopoly. You had no reason to do anything else. Because it's like the big banks in Canada. You're getting this monopoly of profits because of limited entry. So we know that that's a system that works. You can't propose that system. We need to give the banks monopoly profits. And so these systems evolved by accident that they got there. So there was the combination of deposit insurance, limited entry, strict examination, limitations of activities, and it seems that it wasn't terribly repressive. And so we did great. I think it's really hard to design that system today. I'm not sure what you would do. Our proposal, I think, is a sensible one. We don't say we're going to insure asset-backed securities or anything, but we were just mostly focused on reviving the existing banking system. But I'm not. I think that would keep a crisis from happening for at least 25 years. But a lot of societies face these trade-offs, and they don't. The way societies work. Argentina didn't just one day wake up and say, "Let's go backwards." They made a series of bad decisions over decades, right? And economists, we don't understand anything about that. If you don't have enough data to run regressions, we just don't look at it. Our economists, they don't care how irrelevant the question is. If it's got a lot of data, it's a good question. But here's a huge question. If you make a bad macro policy decision every 10 years, how many do you have to make before you're going backwards? Right? So Dodd-Frank. Is Dodd-Frank bad? Well, it didn't solve the problem. It might have some good things. Is all this litigation against banks bad? Remember, JP Morgan just announced a quarterly loss. They're not accused of anything. They bought Bear Stearns, which the government wanted them to buy, and they bought Washington Mutual, which the government wanted them to buy because Hank Paulson's an M&A guy. And now they're being sued for what Washington Mutual and Bear Stearns did. And you know why? The government just wants to go after banks. So you think, well, okay, that's not so bad. They can survive that. Well, how many things do you have to have before you die? I mean, 1,000 tiny pinpricks can kill you as easily as a club to the head once. So it's very hard to see this.
Just the last question, which I'll give myself to deter with time. Just going back to the very beginning and the nature of the project. You're essentially talking about a system that it has different currencies, different plumbing, but it's essentially the same thing as a 19th century bank run. It's the absence of confidence.
Yeah.
Okay. Has the system become more fragile over the last 20 years because of the globalization of finance?
Okay, so let me give you some empirical observations on that. This is from like 3 or 4 papers that aren't published yet. So, and I think we talked about this, but for everybody else, suppose I go to China, I buy a t-shirt for $1. So my current account goes down by $1. China's current account goes up by $1. China then takes the $1 and buys a treasury bill from me. So now my capital account goes down by $1. So current accounts and capital accounts are net. Capital accounts are net financial transactions, right? So, for example, one of the things that happened before the crisis, European banks set up these vehicles and bought $800 billion of asset-backed securities denominated in dollars. They did that by issuing commercial paper to money market mutual funds in dollars, $800 billion. That cancels out. That doesn't appear. But the gross flows in the capital account are just orders of magnitude bigger than what they used to be. And that tells you 2 things. The first thing that tells you is that the old rule about to control your own monetary policy, you have to have floating exchange rates. This says you got to have more than that because otherwise the world banking system's controlling your monetary policy because they are the ones behind this huge capital account business. So that properly should have been put in the current account because it's a product. We're selling safe debt, right? But now that the system is so entangled that you could actually have a run somewhere else, and we'd get the consequences of it, right? You know, that's the problem. And they don't know either. You know, in China, they don't know, like their shadow lending system. They don't really know how that's financed. I mean, so, you know, all these problems are going to grow with globalization.
And thank God that the American Congress is ready to take on that challenge and resolve it. Thank you so much.